What would you say are some other key metrics that you guys are looking at when you guys are looking at SaaS businesses as investors? So revenue, let's say $1 million ARR, you're growing, you're looking to grow, raise some capital at this point. What else are some key points you guys like to look at?
Yeah, it's a good question. It's funny. It's one that we discuss a lot internally. That one of the beauties about software is, once you've kind of got an established product and you have your go-to-market ready, you can really just like roll out the business and grow methodically. Which is something that, I think is very rare in a lot of other segments. And so SaaS kind of tends to lend itself a lot more strongly to a metrics-based approach. You can really actually benchmark businesses, even if they're different verticals or, horizontal layers. There is a sort of that nice replicability. So I do spend quite a lot of my time kind of like looking at SaaS metrics. I think, really the first one that I always think strongest about is just growth. Like what is your business growing? What's your top line growth rates? And again, you need to kind of like, every business is growing at different levels, but there's a really nice framework. I'm not sure if you've come across it. It's by Battery Ventures. It's the T2D3 framework, and it's kind of like it was established a while ago. And some people say it's a little bit outdated, but it's really at the core. It's kind of like when you hit $1 million of ARR, your kind of next few years you should triple for 2 years and then double for the next 3 years. And it's funny. So essentially, you're going from 1 million in year 1, 3 million in year 2. 9 million in year 3, it's kind of that, and then you start doubling. And it's really interesting. I've spent a bit of time kind of like benchmarking some of our companies and some of the other ones that we've met, and you tend to see there's a little bit of a correlation to some of the best performing companies and that growth curve almost. So it's no hard and fast rule. That's just kind of something that I find quite interesting to always look at. So that's kind of like one of them. I think there's always other things that you look at around, like the magic numbers and the rules of 40 that people are always there's a lot of stuff like that's in vogue, and yeah, so we kind of look at all of those things. We look at, I guess, capital efficiency, which is kind of how much capital has been raised for your level of ARR, and there's different rules of thumb there. Sometimes it's a 2-to-1 relationship, sometimes it's a 3-to-1 relationship, depending on if you've got different scale, and then there's always
you're talking about specifically about the CAC to LTV ratio there, or?
No, this is capital efficiency. It's slightly different. So it's kind of like, how much have you spent as a business to get to where you are for your ARR base? So you're essentially taking your ARR and you're dividing it by your capital spent to date, if that makes sense. So yeah, it's kind of an interesting one to benchmark, just to get a sense on how efficient has the business been, because a company could be at 1 or 2 million of ARR, but if they spent 20 million to get there, that's probably less interesting than some other businesses. So I think that's always an important one to look at.
So 2-to-1 is probably a good. 3-to-1 would probably be pretty. Yeah, 2-to-1 is probably a good benchmark, right?
Yeah, exactly. 2-to-1 tends to be pretty good, and 3-to-1 I would kind of say is like best in class. If you're around there, then you're doing pretty freaking good. So
is there something that you'd look at and you say, like, this is a red flag and automatic deal breaker that you've typically seen? Like,
yeah, it's a good question. I find there's a lot that you need to understand around like the go-to-market and the sales metrics. So, like your paybacks, like you said, your CAC to LTV and your payback are 2 really important ones. If those are completely out of whack, then that is a pretty big red flag. And I do think, one of those, the key ones that I do spend a lot of time is actually the magic number. So yeah, I don't know if you're familiar with the magic number. It's the one which is essentially you take, your new revenue for a period and you divide it by your sales and marketing costs for the previous period. So essentially, how much new revenue are you adding for every dollar of sales and marketing? It's kind of another good sort of benchmark just to understand, and the general rule of thumb is, if it's above 1, that's probably good. If you add a dollar of revenue for every dollar of sales and marketing, that's a pretty scalable business model, right? But it's funny, you'll see some businesses where those metrics are just completely out of whack. Like they're adding like $5 or $6 of sales and marketing to get $1 of revenue, and that for me starts to become a bit of a red flag, just because I think it can be an indicator that you haven't found product market fit, or you haven't actually kind of really nailed your go-to-market as well. You're still probably kind of in fishing around for that.
Yeah, see what's sticking. So that's interesting. So just to clarify, you would take incremental growth of revenue and then divide that by a period of time over your combined sales and marketing budget. Okay.
Exactly. So you take your previous period. So like, if normally it's done quarterly, you kind of look at this quarter's new revenue and last quarter's sales and marketing. And I find that a really strong metric.
I like that. Cool. So once you guys invest in the company, how would you describe the relationship afterwards between you and the founders, and how you guys work with them after the investment has been made?
Yeah, it's funny that one, because I think every business is different and every investor is different, right? And personally, like for anyone who gets to know me, I'm a pretty informal, informal guy. Like I kind of like to build like a personal relationship with the founders. So, I've got some founders who have me on WhatsApp and they text me every other day, right? Like, just like updates and the sort of, the sort of people who will go to the pub together and get a drink. But, at the same time, there's other companies who tend to take a lot more of a structured approach. They'll only, keep you updated at quarterly board meetings. They'll kind of, keep you at slightly arm's length. And I think that's kind of one of the elements of being a good investor is really kind of working with your founders in the way that's quite symbiotic. You don't want to be, anyway, in my belief, you don't want to be sort of like a really hands-on guy or putting a lot of pressure on them if that's not the right situation for that. So I think, every good investor should really build, focus on their relationships.
No, that makes sense. So I realized you joined Felix, slightly later. You weren't there at the early stages, but I'm just kind of curious here. Maybe you've also worked in investment banking, so maybe you understand this problem. Obviously, you need capital to make deals. That's kind of the fuel of the fire. But you also need deals. You need track records to get that capital. It's obviously a chicken and egg problem that you're facing. What would your advice be to maybe some upcoming investors to kind of solve that issue?
Yeah, it's a really good one. It's definitely, I think, like I'm sure a lot of people find it frustrating when you look outside in. You're like, how the hell does this industry make any sense? Because to do deals, you need to have track record to invest money, right? It's kind of slightly counterintuitive. I guess, one thing that I think is most helpful is, the public markets, right? Like you can invest in companies on the public market with $1, right? And actually that was kind of like one of the things that I did, because I've been doing, like I said, public investing since I was like 15 years old. Not that you can build like go out and raise money on your public's exposure as a young person, but it really just kind of helps you kind of like credentialize yourself a little bit when you get into those discussions. Like when you first say, I want to become an investor, and you start talking to people, if you can show you're really passionate about, investing, and you've put your own money to work, and you can sort of pitch a few stocks and say, like I invested in this company a couple of years ago, I got this sort of return. And, it's not something that's bulletproof, but it definitely helps you kind of just get your foot in the door a little bit, right? So I think anybody who, the most fortuitous people follow this sort of the very, I guess, traditional linear route into investing, which is, you study finance at university, you get a job in banking, you work for a few years or as a consultant, and then you can kind of leverage that to get in. But, I think that's not what the norm these days, actually. I think there's a lot of people coming at it from different solutions, people with operating experience, people who've, made a startup and they want to get into investing. It's kind of show a passion and try and, show some sort of a track record where you can.
That's smart. I mean, at the end of the day, they're looking at you like capital allocators. And if you know how to do it at the small, what's your decision-making framework at looking at small investments, it doesn't matter what it is. And then you can apply that to, that makes sense.
Yeah.
Cool. So, beyond the track record and your performance, I think the next step is obviously, trust in this investment industry. I think that's probably one of the most valuable assets that you can build as with the GP, right? The GP with your LPs. What do you believe are maybe let's say three main reasons why you can trust someone after the first meeting? Like when you look at, between you and the entrepreneur, or, LPs trusting you as a GP.
Yeah, it's also, you're full of good questions today, Akeel. It's definitely not your first podcast, but I think like for me, trust, really in a weird way, it comes down to intuition a little bit. Like I feel like you can, once you meet somebody, especially face to face, it's a little bit harder these days when it's like, removed via Zoom, but you can get quite a good sense pretty quickly if someone's genuine, if they're kind of, leading you on or not. And I think you kind of need to really trust your gut a little bit and get a sense of that person. But if you don't have that sort of, that gut reaction, there's always, track record and references, right? Like you can go back to data, you can look at somebody's history, where have they worked, what have they done in the past, can I talk to people they've worked with, and build that sort of, a little bit of a view of that individual in their history, right? So you kind of got to lean a little bit on your network as well, I think, or if not yours, people, associated people within your network, and you can get references, you can find out, quite a fair bit about people and about investors, using those two levers.